All right, update everybody. It is, what is it? Friday, August 16th. All right, I didn't have time yesterday to make a video, and today I'm a little bit busy, so I'm just doing this quickie. Let's bring everybody up to date. The day before yesterday, that's actually also when I made my last video. I sent out early in the morning before the market opened to my subscribers. I said something was wrong. And what I was talking about was a very obvious slowdown in the fiscal flows. Now, let me clarify something because some of you were confused on here because I said way prior to August 8th, I said that would be the buy window and we would have a very sharp upturn. And that was based on reserve flows, reserve balances, okay? Because the fiscal, up until very recently, the fiscal was just in a very strong uptrend. It's not even something that I was paying much attention to because it has been in a very, as a matter of fact, on record pace. It was on record pace, and it still is, to make this year, this fiscal year, a record year for spending. But so that was kind of in the background for me. It was a constant source of support for the economy and the market. So I just assumed that would continue. So I then reverted to or shifted to looking at these reserve flows as timing for these market cycles up and down. And they have been very, very effective, as I mentioned many times here. These reserve flows affect what banks do, and banks mix their asset or adjust their asset mix, and it causes selling in the market and it causes buying in the market, and it is something which is completely tradable and known in advance when these peaks and troughs are going to happen. So I had that August 8th, and August 8th we had a rally, and then what I have been noticing, or what I had been noticing, was all of a sudden the fiscal flows, the spending, started to slow down noticeably. I should say precipitously, it started to slow. Now that is the fundamental bedrock of my analysis. That supersedes everything, including reserve balance flows. Because for me, fiscal is everything. I mean, monetary policy is important and it has effects, but overall, it's fiscal policy. So when I saw that precipitous slowdown in Treasury withdrawals, in spending, I sent out that email on the morning of, the 14th, 2 days ago, and I said, something is wrong. You got to take downside protection. We are going down. And we went down big. And as a matter of fact, I had some people email me, said, Mike, this is not your style of trading. I told people to sell on the open. They said, Mike, this is not your style. This is zombie style. Have you lost your mind? Have you become a zombie? I said, look, the opening at that time, 40 points down in the S&P. I said, that's a good level to sell because there's not going to be a bounce. And the rest is kind of history. We ended up down 90. Now, yesterday, in continuing my analysis, and by the way, let me segue here to something. Let me say something, because I have been looking for a reason why the fiscal flows slowed down. That shouldn't happen. All spending is predetermined by budgets. And then everything is automatic and programmed into the Treasury's payment system. It's not like somebody can arbitrarily start to cut spending. Not Trump, not some department, not some agency, because all this is predetermined by budget. So it was really, really bothering me, like why this was happening. And it's still a little bit bothering me, but I think I have a reason or an understanding why. And again, it goes back to the debt ceiling. The debt ceiling, one of the effects of the debt ceiling was that Treasury not being able to sell bonds, and we'll get into that in a second, was relying on tax receipts to make all the monthly payments, and it was running out of cash. That's why Mnuchin kept saying to Congress, hey, you got to raise the debt ceiling because we're running out of cash. And the Treasury balance got so low that I think what happened was Treasury started to slow payments, just like maybe sometimes you have that situation in your own bank account. When your funds get low, what happens? You slow down the payments. You don't make the payments on time. You maybe wait a little bit. That's my speculation as to what was going on. Now, if we see the Treasury balance start to go back up now with these renewed debt sales, as it should, and the spending keeps on slowing down, then I missed something. And something is wrong and something is amiss and it's not good. But I don't think that's how it's going to play out. I think we're going to see the spending reaccelerate back up and get back to trend because it came off trend in a big way. So that was my reason why I said, hey, forget the reserve flows. We got to take some protection, downside protection here. And sure enough, we were down 800. Now, yesterday, after some more analysis, I saw a rebound in the flows, not back to trend, but something. And I know that with the debt sales now having resumed, okay, we're going to start to see that Treasury balance run back up. And I am assuming we will get fiscal flows back to trend. So I sent out yesterday morning, I think we're going to see a rebound. I was still a little bit skeptical yesterday morning. I said, I think we're going to see a rebound. You could play the upside in the market. But I said, I don't know if it's going to hold. And after further analysis last night, I think we're on track to see this thing correct. I'm talking about the flows, fiscal flows. So I sent out this morning, the worst is over. All right, that's my speculation right now. The worst is over, meaning we head back up, market heads back up, monetary conditions get back to normal, and most important, fiscal conditions get back to normal. Folks, I never said this was easy. But we have the understanding, or I have the understanding, I have the information. Now, nobody else is looking at this. I say this very often, but it's true. I have a right to say that because it is true. Now, one more thing. It is fascinating to me, and I could be wrong about this, but I've talked about this a lot. But let me say it again. It is fascinating to me that nobody on Wall Street or outside of Wall Street has connected the dots between the impact of the debt ceiling and the dearth. That means there have been no new Treasury sales for 4 months. Treasuries are the most ubiquitous and most important collateral in the world. No new Treasury sales for 4 months, and nobody has connected the dots as to why interest rates have plummeted and bond prices have skyrocketed. And it's not only the fact that there has been no new Treasury sales, but banks throughout the world are required to hold Tier 1 assets to conform to regulatory constructs. And Treasuries are the most important Tier 1 asset that exists. So there's no new Treasury sales. Banks throughout the world are forced to hold Tier 1 assets, risk-free Tier 1 assets, Treasuries, the highest quality of those. And no kidding, the banks are going to be bidding them up because regulatory statutes require them. So this whole thing, I think I'm the only guy out there who's saying this now. maybe now when new treasury supplies slowly start, and by the way, it doesn't just in 1 or 2 days, get back to normal. You've had 4 months of no new treasury sales at a time when the Fed was bringing reserves down and banks needed these assets. It's going to take some time, but I still believe this is the explanation for this unprecedented bond rally and collapse in yields. We'll see. Anyway, that's my update. If I have a chance, I'll do another video later today, but if not, everybody have a great weekend. Bye.